Hello, everyone. Thank you for joining our latest episode on everything tax. Today, we will be talking about the key pointers and aspects, um, what to watch out for while implementing and transitioning into the new corporate tax regime, and also touching upon some important points from a transfer pricing perspective. With me, I have Mankush, who is a senior manager in our transfer pricing team.
Hi
Hi,
Pratim.
Mankush.
Hi Pratim. Hi everyone.
And I'm Pratim. I'm a director with the direct tax team. So why is this important? Why are we doing this podcast? Because most businesses are done with their impact assessment
Yes.
and now in the phase of implementation. But what does that mean? What are those key pointers that one must look for? And we hope to touch upon some of the important aspects and pointers in today's podcast. And with this, we can begin with Mankush, who can throw some light as to those pointers from a transfer pricing aspect, and some things with opening balances. Most businesses are
Yeah.
quite worried about that. So
Correct.
Mankush, over to you.
Yeah. Thanks Pratim. Thanks everyone. Look forward to this new implementation which is being happening with all the entities in the UAE market. And rightly said, with transfer pricing coming into picture, one of the key important critical aspects is to start initiating the transfer pricing policy for
Yeah.
all the entities who are having the intercompany transactions or the related party transaction or transaction with their connected persons, as to how the each intercompany transaction will impact their businesses.
Hmm.
Wherever there is requirement to carry out a detailed functional analysis, do it along with carrying out an economic analysis, or which we call it normally a benchmarking analysis,
Yeah.
wherein each related party transaction would need to be justified as to how the pricing between those two related parties are at fair market value or at commensurate with the arm's length pricing policy principles from a UAE transfer pricing perspective. So that said, one of the critical aspects to start devising the TP policy, because that will stand as a first line of defense documentation which will encapsulate all these details.
Hmm.
So it becomes even very critical for all the entities to start focusing and start implementing that first. Coming on to the next step, I think apart from TP policy benchmarking analysis, it is also important to revisit or amend or draft your intercompany agreements. That
Yeah.
is again a very critical important aspect which every entity in the UAE needs to focus upon. Wherever there are existing intercompany agreements, the UAE transfer pricing law would require to find out if there are any gaps or loopholes, and if there are any possible deviations wherein the entities can amend those agreements or redraft or realign as along with the UAE transfer pricing laws or principles that they have carved out. So it becomes even more critical to eventually carve out those factors into the documentation perspective from an intercompany agreement standpoint. And also, one more important aspect which I would like to highlight here for everyone is, it is very important to bring out the actual conduct of
Yeah.
the related parties into picture and document that in the intercompany agreements, because more importantly, when the transfer pricing audit or scrutiny assessment starts, the FT authorities will primarily question the conduct as to how that conduct is actually being implemented in your related party transaction. So your conduct should actually match with what the entities are doing,
Yeah.
and it should actually justify your position in the market. So these are the two critical aspects.
I think conduct is very important, right, Mankush, when it comes to TP, because there is a belief in some sectors or in some corners of the market where they say that I'll just draft an intercompany agreement,
Correct.
put a price on it,
Yes.
and that's my TP done, right? But
Yes.
it doesn't work like that. It should at least reflect economic realities,
Correct.
what you're actually doing,
Yeah.
because what we have seen back in in other jurisdictions
Yeah.
is that when it comes to TP audit, they ask people from the company, they interview them, and
Correct.
they interview them without tax consultants presence,
Absolutely.
and these interviews can be quite intense,
Yes.
and plus they also look at email trails and things like
Correct.
that.
Correct.
So
Correct.
it is not just it has to be a substance over form.
Correct.
While you have to make sure you have the substance, but you should also ensure that the form backs up the substance, right?
Absolutely.
You no point just having form and without any substance.
Exactly, absolutely.
Yeah.
Rightly said, Pratim. I think, in a way, just to have a simple intercompany agreement and just to have that benchmarking analysis and arm's length pricing methodology and the pricing justification factors, it is
Yeah.
more important to have all these aspects combined together and make one comprehensive and a detailed document
Yeah.
which will not only safeguard your position but will also help you to justify as to how you are actually conducting your related party transactions
Yeah.
and how you are justifying those related party transactions on an arm's length basis.
And also, I think beyond agreements, so I think a business should also ensure that they invoice on a timely
Correct,
basis,
correct,
and also to ensure that these related party balances are paid off on a regular basis and
correct.
not kept outstanding, because
Absolutely.
I think we have discussed in the past previously that if related party balances are outstanding for too long, they can be recharacterized as a loan.
Absolutely.
So
Absolutely.
it has to now, it's a paradigm shift for
Yes,
businesses.
yes,
But while implementing, there's so many things now to take care of. You
yes.
have to ensure the pricing is as per market value,
Mal-
arm's length, for which you have mentioned we have to do a search.
yes.
Ensure that you have to get an intercompany agreement in place.
Correct, correct,
Ensure you're invoicing on time. Ensure you have a regular payment cycle, right?
correct, correct.
For those. So it's a lot for businesses to now take care of.
Absolutely, absolutely. It becomes even more important for them to cater all these requirements now.
And when I'm talking about these related party balances, Mankush, one important point is,
Yeah,
uh, the opening balances for
correct.
related party.
Yeah.
And can you just throw light on, what the law says and what are businesses supposed to do?
Correct.
Yeah.
Very important. I think this is one of the practical hardships which all the entities are facing. Not just the entities, even the consultants on the other side of the fence are facing, just like us. So, Article 61 of the UACT laws talks about that, while drafting your opening balance sheet for the first tax period, all your related party opening balances
Yeah.
needs to be restated and brought up to the arm's length pricing policy.
Yeah.
Now, the practical challenge is that how you should do that restatement. That is
Yeah.
the prime focus for all the entities. So eventually and practically, the transfer pricing guide and in fact the law has not provided any practical guidance as of now as to how the restatement should be done.
Yeah.
But in a way, in this market, we have been advising the entities, and we have come across all those situations wherein the combination of options can be taken. Either you square off those opening related party balances while preparing your balance sheet and find out that whether pay it or receive the balances in cash or pay it, settle off wherever to the maximum possible extent. Or second option can be to write off those recoveries or write off those balances as bad debts wherever there is not possible to recover or pay off those or settle those balances, or a combination of two. Now, on the other side, when there is, it's also to be seen that whether it is practically feasible for the entities to do these exercises or not.
Exactly. Yeah.
There was one relief which was issued in November 23 by the UAE FTA authorities, wherein the accounting standards and interaction with the corporate tax guide provided one sort of relief, or I would say one sort of important aspect, wherein they highlighted that if you are not able to restate the opening balances at arm's length price, or wherever your pricing or adjustments or deductions are not reflecting the true arm's length standard or true arm's length pricing policies, or are not at fair market value, then possible adjustments can be made either in the first tax period or in the subsequent tax periods. So that
Yeah.
relief they have given. So possibly one inference may be drawn by this, that you necessarily need not to restate all the opening balances as at the first day of the first tax period. The same can be done even within the first tax period or subsequently, but that is only a guide which is supplemental in nature. Again, important aspect is to see that what exactly that opening balance is.
Yeah.
How is it impacting your future
Yeah.
taxable income?
Yeah.
So importantly, then you need to take care into account that whether that impact will obviously hit my profitability or taxable income in the future or not. And if that impacts your taxable income, then it is required to carry out that at arm's length and restate it to the maximum possible extent.
Yeah. I think practically, it's easy to say that you can do the arm's length in the year it impacts your taxable income, but doing that could also be very, very challenging.
Correct.
Just say you have inventory in your balance sheet.
Yeah.
I can think just inventory,
Yes.
and then tomorrow it gets into your cost of goods sold
Correct.
as a in your P&L, and suddenly you have to restate the amount as per transfer pricing. Then you have to look at which year you bought this inventory,
Correct.
and then you have to benchmark as per that year,
Correct.
then restate it. It's quite practically challenging. I think
Correct.
I
Absolutely.
think the I think businesses should look at cleaning up old balances, as much as possible by December 23.
Hmm.
And if anything's remaining, I think then practical calls can be taken while
Correct.
adhering to the law.
Yes.
And yeah, I think. But when we're talking about policies, right? The just beyond TP policies, we have seen in other complex tax jurisdiction that there are other kinds of policies that usually are maintained for tax reasons, right? Or
Yeah.
driven by tax. Say something as simple as a reimbursement policy,
Correct.
or
Correct.
something as simple as a salary policy or a
Correct.
remuneration policy.
Right.
So just by that, Mankush, could you throw some light on that?
Yeah, I think very important said. I think for each reimbursement or every kind of transaction or such reimbursement which you just spoke about,
Yeah.
it is important for businesses to devise a policy or have an internal documentation in place wherein they can encapsulate all these expenditure along with the supporting documents for which they are incurring the business expenditure, and they can, with the help of this, they can prove a rational or devise a substantiation methodology around its expenditure incurrence, that why this expenditure was incurred for the business
Hmm.
and what was the need. And since they have that supporting document and that internal policy will come into picture, that will again safeguard your position to claim it as a tax deductible expense.
Yeah.
And if in case the audit or assessment starts, FTA will always question the legitimacy of the business expenditure or legitimacy of rationale behind that, and eventually that internal policy or internal document will prove as a safeguard mechanism.
And that's very important, I think. And just having a policy is not enough. You should also back that with actual conduct
Correct.
and implementing that policy. There has to be some discipline brought into businesses going
Yes.
forward, that it is not only transfer pricing policy. You set it, you adhere to it, you have discipline. From a sales perspective, you're supposed to talk to your sales team on that, but it has to be also other things like reimbursements, collecting those invoices, collecting those receipts from your
Receipts.
employee,
Correct.
and having that discipline, because when tax audit opens, you will not have time to
Exactly.
do it at that point in time.
Exactly.
So you have
Right.
to do it now,
Right.
and all these things have to be a proactive effort.
Correct. Correct.
Because if it's reactive, and if you do it at the time when you get an audit notice, that's a slippery slope.
Yes.
And yes, and then you're more prone to adjustments at that point in
Correct.
time.
Absolutely.
And
Absolutely.
Mankush, I was just thinking, there's certain other kinds of points here. When I look at, when I'm talking about a policy for reimbursements, and I'm talking about discipline, right? But most businesses also have to adapt their ERPs and systems
Correct.
for it, right?
Absolutely.
And I think when you're doing a policy, you must also see, today, do I have the system
Yes.
to can I put this into my ERP? Can I
Yes.
upload this receipts into the ERP? Beyond that, just
Correct.
update your systems to capture the capabilities of tax grouping,
Yes.
to see whether, if you're free zone, whether your system is capable of tracking qualifying income, non-qualifying income.
Absolutely.
So I think the first for businesses is to do an impact from a system perspective,
Correct.
and then to see whether the implementation is happening for the system. Because if you don't update your system to match what
Correct.
the requirements for corporate taxes, then that can also be, if you're doing everything manual, then that can also be a time consuming process. I
Correct.
think one thing, I think, Mankush, that we have seen that a lot of systems in other jurisdictions sometimes are adapted to capture related party
Correct.
transactions, right?
Absolutely.
So I
Yeah.
think that is one thing that we need to see,
Absolutely.
because when
Right.
we are, and you can throw light, what has
Yes.
your experience been while extracting data for related party transactions right now?
It's been a challenging, of course, challenging roadmap to extract data from the systems, and
Mm.
that is where we have experienced that in Indian jurisdictions, which is a very complicated and complex jurisdiction itself. So now here in UAE, it is very important to equip your system, your ERPs, your SAPs implementation, and make it equipped and look at more sound
Yeah.
to imbibe all these latest developments from both CT and TP developments. put your system and make it more competent enough to capture or give those definitions from related party perspective, that which entity is qualifying as a related party and which is entity is not,
Hmm.
and encapsulate all those intercompany invoicing agreements and all those templates which can be fitted into the implemented into your system, so that once the audit starts, or once even when there is no requirement of audit, the implementation can, or the system can help the management or entity to extract the data very easily, and that can be relied upon not even just by the entity but by the consultants also who are performing the year end compliances.
Hmm.
So the system implementation and system making it equipped to match your transfer pricing skill set, it is a very important and a last, I think, last point, one of the last point wherein we could ask the entity to adopt this and make you good use of it.
Hmm. Hmm. And I think building on from that, I just spoke about tax grouping,
Correct.
right? And I can think about from tax group, and aligning your entities for tax group is also very important implementation point, where I think one of the key condition is that those conditions have to be met from first day of the tax year, and
Absolutely.
I think that time has gone
Yes,
right now, at
yes.
least for 2024. So businesses were supposed to at least align the shareholding, create that parent entity by 1st January 2024. But if you have not been, it's not like you cannot form a tax group in the second year. You can, right?
Yes,
At least
absolutely.
ensure that it's done this year,
Yeah.
and you meet all the conditions, and that shareholding condition or the ownership interest conditions that are there are quite stringent, and ensure that this, we have seen in other businesses
Yes.
that this concept of beneficial shareholding is there, but our tax law does not recognize the concept of beneficial shareholding for at least tax grouping.
Exactly.
You need to
Right.
have both legal and beneficial
Yes, yes.
shareholding. That means all these, the current practice of these, having these side agreements. I think businesses has to transition away from it,
Correct.
and most businesses have tried to at least get almost full ownership
Correct.
of those entities that were
Yes.
on paper JV entities.
Yeah.
They may have had beneficial ownership rights
Ownership.
of the economic flows from that shareholding, but that may not suffice for tax grouping. So
Absolutely.
it's very important to have both legal and beneficial shareholding, and to amend the charter documents as well.
Correct. Absolutely.
And and moving on, I think when you form a tax group, you must also know which entities are part of it. So when one critical point, and it's a low hanging point, is registration, right?
Correct.
So I
Yes.
think now it's quite clear that every entity, regardless of whether it is part of the tax group or not part of the tax group, should register. There is no timeline to it, but they should register at least as soon as possible, so
Correct.
that it doesn't happen last moment, because the portal might get, we've
Absolutely.
seen, sometimes it
Yes.
gets overburdened. And also there's a timeline for tax group registration, which is
Correct.
end of the tax period. So if
Correct.
you don't register your individual entities on time, suddenly you might be faced with the challenge of registering the tax group
Tax group.
by the end of the year. So
Correct.
businesses should plan to register the entities, over a reasonable period of time during this year. At least have a target of at least end of Q1 or end of Q2
Q2. Correct.
minimum.
Yes. Right.
Um, and when you're doing a tax grouping, at least I feel that it's also important to do a pros and cons analysis, and not just dive into a tax group. So
Correct.
people think,
Yeah.
let's just do a tax group, but it's important to do a pros and cons.
Absolutely.
So regarding that, let's move on to some, these are
Yes.
small points, but Mankush, can you just throw some light on, your CT provision has some grandfathering provisions,
Correct.
right? Can you just explain the provisions, and maybe then I can touch
Yeah,
upon,
yeah, for sure.
yeah,
So, one important aspects in the UECT law is about the provisions. And since we know that, the law itself does not provide any, when it comes to a comprehensive guidance on
yeah,
provision, they only say that if the provisions are as per the IFRS,
yeah,
it would be allowed as a tax deductible expense. But most importantly, Thereby, just saying that provision would be allowed, it is important for the entities to have a full fledged working and an analysis which is backed by the historical working or historical calculation as to how they are deriving those provision in their books of accounts, how they are
Yeah.
creating those provision in the books of account, so as to create more lucrative substance around it, and in order to safeguard their position from a
Hmm.
FTA scrutiny or assessment or non-deductibility aspects also,
Hmm.
which can also help them to prove that that yes, I have a backup, I have a basis, I have a working, and based on that I have created a provision. So in a way, in a nutshell, an ad hoc basis of creating a provision will is always questionable by
Yeah.
the tax authorities. So in order to make it foolproof and legitimate expenditure, you need to create a full-fledged basis of working around it and calculation which can uphold your provisions in the books of account and make it a tax deductible expenditure.
True, true.
Yeah,
And maybe have some policies around
correct.
provisions as well, that
Yes,
how do you provide for certain items, how you
yes,
don't provide, what is the company policy, what have been the historical trends.
correct.
I think there's a lot of work that businesses need to do
Yes,
in that respect. Now, coming to that, we are talking about provisions and there could be certain other things. So now, when you spoke about certain uncertain areas, right? Now you will have multiple positions where
absolutely.
there will be some uncertainty,
Yes,
where there'll be two interpretations or three
yes, yes,
interpretations.
yes,
So this is also an important implementation
correct.
point. I think businesses should wait,
Yes,
and if there's no clarity on these positions, they can, at least think about approaching the FTA for a
absolutely.
clarification on
Yes,
those. It's
yes,
better to get a clarification than actually run blind,
absolutely.
right?
Yes,
Yeah.
yes, yes,
Okay. And what about trade licenses? Sometimes we've seen trade licenses not being aligned with the actual conduct. So,
yes, yes.
Mankush, could you throw some light?
Very common point which we have come across while dealing with the impact assessment in this market, because most of the entities generally have their trade licenses, but there are certain cases wherein the actual activities that they are performing is not aligned with the activities mentioned in the trade
Yeah.
licenses. So we have been advising the clients to align those actual activities that they are conducting, and along with the activities that are mentioned in the trade license, just in order to avoid any possible questioning from a deductibility or disallowances aspects. That is one important aspect. I'll just take a step forward on this, since you talk about alignment. There is one more aspect which talks about visa alignment,
Yeah.
which is very common. So in a way that we have seen across UAE sector that most of the entities wherein their employees, so visa are in with certain with one entity, but their employment and payroll contract is with other entities. So
Hmm.
it is very important to align all these aspects,
Hmm.
and actually the legal employer of that particular employee should hold all these visa, employment and payroll contracts. If not, then there is a possible mechanism to either cross charge that cost to the other entity who is bearing those expenses,
Hmm.
either on a cost to cost basis. And then second aspect is that when there are common employees, which is again an important factor when we deal with shared employee cost or common employees who are working not just for one entity
Hmm.
but for other entities in a group. So it is very important to cross charge or devise a cross charge mechanism for recharging the employees or such common employees cost to all the group entities wherever the time is being spent and wherever those entities are getting benefit with the validation that the employee is bringing into account.
Yeah.
That can be either on a cost to cost basis with the appropriate allocation key like time spent, time sheet, which is I know which is practically not
Yeah.
feasible. But again, then certain other aspects like revenue, which can be devised to allocate the allocate their cost to the other group entities, or it can be done either on a markup. Then markup is a subjective issue. Then we need to see whether what kind of actual role or actual services are getting rendered wherein it requires a markup to be added or not.
Hmm.
So Pratim, I think with this, I think there are a couple of aspects which would I would like you to throw some light, which are
Hmm.
I think very critical from entities perspective. One is obviously grandfathering benefits. Second
Ah.
is one of the most hot topic, which every entity is running behind, is deferred tax.
Yeah.
So and obviously on valuations perspective.
Yeah.
So I would just like you to throw some light on all these three critical important aspects.
Um, I think okay, that's a very loaded uh, ask and requirement. So one, I think let's discuss this grandfathering, right? So the corporate tax law says that if you have certain qualifying assets that are
Correct.
recorded at historical cost, which is your immovable properties, which are financial assets and liabilities, and intangibles, right? Now, what the law says is that if you sell these qualifying assets in the taxable year, the gain that pertains till the beginning of the first taxable year. So till the gain. So if you sell it, say in 2025, and you bought the asset in 2018.
Yes.
So since 2018 till 2023, December 23, the gain pertaining to that period will not be taxed. Only the gain from say 24 to 25, right?
Oh,
So it's basically grandfathered, and it says that
correct.
okay, pre-tax period, any accrual of any gain will not be taxed. But there are different methods.
Okay.
Now, for immovable property, they have said that you can do either time proportion methods. If the gain is 100, you can apportion between 3 years prior and 2 years later, or you get a valuation report
Correct.
as on 1st January 2024. So, and each businesses is supposed to now evaluate which option is best for them. While
Correct.
this option, you have time till the first tax return, but since you're required to get a valuation report as on 1st January, it's critical to do this analysis right now.
Yes.
And if you need the valuation report, you need it on 1st January 2024.
Correct.
So it's an important implementation step.
Yes.
Now, you also spoke about other things. One more point that I wanted to touch upon is the law also provides a flexibility to companies when, whether to take certain unrealized gains and losses, say, impairment
Yes.
gains or losses, or fair value gains or losses, whether you can take the deduction for that or offer it to tax, depending if it's a gain, as and when you pass those impairment or fair value transaction on an unrealized manner,
Yes.
or you can add them back to your income and take it only when you realize those
Okay.
gains. But so that election is also there. Again, businesses should, before, I know you have time till your first tax return to select which option you want, and it's an irrevocable option anyway.
Yeah.
But because it is irrevocable, you should carry out a detailed analysis as to which
Absolutely.
option suits you best.
Yes.
Right?
Absolutely.
Because there are pros and cons to both.
Obviously.
For some businesses, it'll be more obvious, but for some businesses, it could be in the balance. So you should do
Correct.
that.
Correct.
And third point, when you said deferred tax, yes, deferred tax is a big point. I think, all businesses, it's not only a 2024 exercise,
Yes.
because the law has substantially been enacted.
Correct.
So any business that are closing their books of accounts on December 31, 2023, just from plain reading of the accounting standards or the
Correct.
IFRS standard, that's IAS 12,
Correct.
you are required to see whether you are supposed to recognize a deferred tax assets or liability, or on any of your assets or liability that are appearing in a balance sheet item. So this
Correct.
exercise has to be done. It has to be a detailed exercise.
Correct.
Um, Auditors in the region are not closing books of accounts until companies or businesses carry out such a deferred tax exercise. So this is a critical implementation point as well,
Correct.
at least for most businesses. And this is quite urgent, and most businesses were closing their accounts
Yes.
right now.
Yes. Right.
So with this, I think we are mostly done with all the critical points,
Correct.
Mankush,
Yes.
and thank you for joining us again. It was lovely sharing these insights and these critical aspects that we have come across while doing implementation for many businesses. If you have any points, that we have not covered, feel free and to reach out to us. We'll be happy to help.
Sure.
Thank you for joining us. Goodbye.
Thank you.